So in this lesson, I'm going to show you how to combine your liquidity inducement alongside your fair value gap. So let's get to work. So in this lesson, the main fair value gaps that we're going to focus on would be our overlapped FVGs. So if you look at this reaction right here, you see the price rejected from a specific point. And if you cut through the candles and you look to the left, you'll see that there was a shelf present. And these are the overlapped fair value gaps that we're going to be focusing on. So the first thing you want to do is, after locating your fair value gap, you want to look to the left and see if it overlaps with a shelf. So in this case, this is your swing high, and this is your swing low, and this is your shelf. And as you can see, it overlaps with your fair value gap. So what you would do here is you would draw a line. By doing this, you have a significant point where you're expecting a reversal instead of having this entire area. So what you would be waiting for now is for price to approach this area and reject. So what is a shelf? As you can see here, you have a break of structure. And that last swing high prior to the swing low that formed the break of structure, this would be our shelf. And what happens inside of our shelf? Buy orders are injected. Why buy orders? Because price continued bullish, and for price to break structure, that means in this area, buy orders were distributed. So when price does come back to this area, price can always reverse anywhere inside of this area. It could be here, 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 or somewhere else. But what we do know for a fact is buy orders were injected. So by now, everybody should know what liquidity is, but just in case you don't, let's go over this example real quick. So liquidity is somewhere where business was conducted, somewhere where price was bought or sold by institutions or retail traders. So in this case, you see a rejection at this level. So what does that mean? That means price was sold at this level, including retail traders selling this price, and their stop losses would be above this level. So now the market is incentivized to take this level out. So let's talk about our liquidity inducement. This will be our approachment phase. This will be the way price behaves prior to approaching our overlap fair value gap. So what you want to see is liquidity being built, liquidity being engineered prior to the contact. So what you want to see is a trap. Price come up and drop down. By this happening, you'd see that price rejected from this level. That means the stop losses are right here because retail traders might have sold in this area. So now price is incentivized to take this level out before contact and approach your overlap fair value gap and then drop back into the range. By doing this, they're taking out all the stop losses from the retail traders and trapping them back inside of the range. And this retail trap, which is your inducement, could be done in various ways. It could be done in a single swing, which you'd see a rejection, and you would know that the stop losses are right here, or it could be done in a double swing, which would be an equal high. So now everybody thinks this is the correct place to sell at, or it could be done in an internal liquidity phase, which would be a rejection and another rejection from an extreme. So the stop losses would be right here. So the function of an inducement is to induce traders into taking an early position. So in this case, you'd see that retail traders might have took a trade right here. Why? Because a sign of weakness been showed and selling pressure started. So their stop losses will be above this level here or somewhere here. So when price does come up and revisit our overlap fair value gap, by doing this, price takes out all the retail traders that sold previously. So anybody that sold in these levels right here already got taken out. And once they get taken out, the initial move starts via purge. So let's take a look at this example. So here you have your fair value gap, which is overlapping your shelf. And what do you have here? Here you have your inducement. This is where a lot of retail traders were incentivized to take a buy. So let's say they already took a buy and their stop losses are right here. Or you can say that this is a rejection level that retail traders anticipate a rejection from to take price long. Or you could also say that this is a level where a lot of smart money traders would try and take an entry. They'll try and take a order block entry right here with their entry right here and their stop loss right here. So these are all the multiple traps the market set up. But the entry that we're looking for is our overlap fair value gap. So what we're waiting for here is we're waiting for price to take this level out and take out all the retail traders, including the smart money traders, approach our overlap fair value gap and retrace. So it'll be something like this. By this level being our stop hunt. Let's take a look at this example. So here you have your clean fair value gap, which is all selling pressure, and it's overlapping your shelf. But what do we have here? Here we have our inducement, which in this case is different than the previous one, which is our double tap. Price came up here, rejected, and dropped down and rejected. So a lot of traders believe that 3 taps is the magical number. So when price comes up here, they're ready to enter a selling position. Not only that, anybody that sold at this level, think they predicted the move correctly, price needs to come up and take them out, forming our purge. So what happened when this move occurred? This is where the stop hunt happened. Why did the stop hunt happen right here? Because the stop losses would be up here. This is where the stop losses would be. Anybody that sold at this level when price came back to the initial rejection, their stop losses would be right here. And anybody that tried to sell the market right here, price took out their stop loss, which would be somewhere here or even up here, for price to actually react from our overlap fair value gap. Here's another example of an inducement. In this case, it's a rejection zone. As you can see, price held level right here, price held right here, price came down, held here, even here. Even though it didn't reject via wick, price did not make contact with our fair value gap. And this is why this fair value gap is not disqualified. Now, let's say that price came down here and made contact and then rejected. Then this shelf would be disqualified. Why? Because price already made contact with our shelf. With our fair value gap, excuse me. So if price came down here, then rejected, then came down to our shelf, this will disqualify this fair value gap. So we want a clean fair value gap with a shelf inside of it. So why is this an invalid fair value gap? Well, the reason here is, as you can see, you have a green candle here, but the last candle is red. So that would automatically disqualify. Now, another disqualification is that this fair value gap been made contact with. As you can see, price made contact with this fair value gap right here and made contact with this fair value gap right here. So this fair value gap has already been used. And the third one is that there is no clear shelf. Again, if you can see here, this shelf is not inside of this fair value gap. And if you can look here, but this will be more of a reach. So you don't see any clear shelf. And when trading price action, you always want clear price action. If you can't read it and you have to double guess yourself, then just skip the trade. And in this case, you have 3 reasons why this fair value gap is invalid. So why is this an invalid fair value gap? Well, even though you have a clear sequence and everything looks good optics wise, as you can see here, your overlapping shelf already been made contact with. So if you take a deeper look, your shelf has already been used. Your shelf is right here, and this candle already made contact with your shelf. Now again, if this shelf was a little bit lower, let's say somewhere right here, and price didn't make contact with it, forming your fair value gap, this would be a good fair value gap. But the fact that this shelf has already been used, this makes this shelf invalid. And then when you look to the left of the candle, you don't see another shelf. So this makes this fair value gap invalid. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and make sure you use code HOLIDAYS for 25% off.